So today, a little bit about your presenters. I'm Elaine Shoemaker, Financial Services Manager. This encompasses collateral operations side and security safekeeping. I've been with the bank forever, most of my life. Started in grade school. No, seriously, 35 years in May. Been a great ride, great group of people get to work with. So,
I am Kylie Mergen. I'm the Director of Financial Services. I started at the bank actually as a collateral review analyst, is what we called them then. We call them collateral review officers now. I might have even come to travel and see some of you. Then I managed that team for quite a while. And then in 2017, was promoted to the Director of Financial Services. And so I oversee both the safekeeping and collateral operations side, which is Elaine's team, as well as that collateral review function. Just a couple of housekeeping items. We have muted you, as we noted on our first slide. And so if you have any questions or anything that we can address for you as we're going through the presentation, simply use the Q&A or chat function, and we will try to address those as we see them pop up. If not, we also have a Q&A session at the end.
yes. All right. So today, our goal for the webinar is we want to explain why the Federal Home Loan Bank performs its collateral verifications. We're going to identify the different types of verifications that we do. We want you to know more about the process, so helps facilitate those on-site verifications that we perform, and some of the emails that I'm sure some of you get. We want to review some of the changes that we've made to the collateral verifications for 2022. We'll discuss the best practices on how to, pass or have a successful collateral verification. And we want to provide resources for ongoing collateral information just for your,
For your use.
Yeah.
Okay, so the first question we get always is, why do you have to do that? Why do you have to come out and see me? Why do you even look at it? First and foremost, it is just a prudent credit practice. We need to validate that collateral that's pledged. If you've attended any of the earlier webinars that we've had, we talk about how the majority of our members report to us via the Qcd form. It's a trust but verify process.
Exactly.
Really. I'm sure that when you lend money to your customers, you validate in some way that the collateral they've used for those transactions is adequate and accurate. We're simply doing the same thing. Additionally, we want to make sure that we kind of keep our boots on the ground and we know what is going on in the market and how you guys are handling things, how loan policies and pledging practices have shaped. I can assure you over the last 15 years that I've been here, they're very different than when I started. I was a lender, so I get it, but lending has changed, and it continues to change and evolve. And so we just come out on site to ensure that we can stay informed about all of what you guys do. Additionally, it is a regulatory requirement. We talked a lot yesterday in our collateral eligibility webinar about how we have to be able to perfect our security interest. Identify a readily ascertainable value, that it can be reliably discounted or priced, if you will, and that in the event, the worst case scenario event, that we would have to liquidate, that we could do so in due course.
Thank goodness we've never ever had to do that.
Exactly. But validating collateral ties into that. And so it is a regulatory requirement that we perform collateral reviews. And finally, it is to protect the bank and all of you, our stockholders. We need to ensure that assets that are pledged to us that are receiving lending value as collateral are properly classified and that they meet our underwriting requirements.
Right, exactly.
And so the key for me is always preparation. You want to ensure that the individuals who are completing and approving the Qcd form are knowledgeable of the institution's assets and our policies. And so sometimes that means that there's a person or a team of people who are responsible for collecting that information and determining what is truly eligible to put on the Qcd form. Sometimes we've seen where There's, you know, maybe the cashier is responsible for reporting on the QCD form because that's more of a reporting practice. But sometimes that cashier doesn't know anything about loans or the documentation or what goes into that. And so definitely having a team of folks, or at least having someone who's knowledgeable of those areas included in the QCD process is helpful. You want to ensure that you're reviewing our policies, specifically the Schedule of Eligible Collateral Guidelines. It is a living, breathing document. It changes often. We're going to go over some of those changes today. So it changes a lot. And if you print it out once and think you got it, you know, the very next quarter it could change. And so definitely keeping up to date on any of those changes that are coming through and the impacts to your collateral is important.
We do try to limit the number of major changes that we do to just once a year, but there are tweaks along the way that we have to make.
Right. Sometimes there's clarification, sometimes there's new regulation, sometimes there's just stuff we have to do.
Yes.
But yes, definitely checking it and making sure that you're using the most up-to-date guidelines. You also want to identify and retain critical reports. You know your system better than we do. You know what your system's capable of. You know what reports you can generate within your systems that will help you identify eligible and ineligible assets. And then once you've built those systems and those reports, you want to verify that they're working and that you have removed all of the ineligible loans. You know, do spot checks, do tests, those types of things. Definitely preparing for a review and making sure that the systems that you've built in order to pledge eligible collateral are maintained is important.
So we actually do two different types of collateral verifications. One is the QCD, what we call a QCD Desk Audit. We do this every quarter. We look at the call report information that you send in or that you have to submit, and we compare that to your QCD form to make sure that it's reasonable, right? We also do the on-site collateral verifications that we come out to your office, go through the loan files with you. So for the desk audits, all institutions who pledge via the QCD form, the blanket pledge members, are subject to this review. The purpose of it, again, is just for a reasonability test. We're comparing the loans on your QCD form to your regulatory reports, just to ensure that you're not maybe listing more on your QCD form than you've reported on your call report, right? And if we identify a discrepancy, you know, we'll be in touch. We're gonna send you an email. We try to, if it's the same thing over and over again, we try to not ding you every quarter, but you know, we'll check in once a year. Is this still a viable option or viable reporting exception? Right. Just so we keep up to date with that.
Yeah. So you put $21 million on your QCD from that in ag real estate, and on your call report it says you have 18 million.
Right.
Well, where'd that other 3 million come from?
Right.
Right. So we're looking for something that's reasonable and a reasonable explanation of where those assets came from. It might just be a typo. Or it might be, oh, no, I pulled those from this line on my call report, and that's why they show up here.
Right, right. And typos are not uncommon, you know, unfortunately. But that's why we do it, right? It's a partnership. So we're looking at your total assets. You know, have you reported the accurate amount on your QCD form to what you've reported on your call report or regulatory report? Any subordination agreements you have in place? Do we have that updated information? Are we apples to apples, right? Or we look at each individual asset categories as well, right? So it's a very comprehensive overview, call report versus QCD. So mentioned that when we note those exceptions, we're going to send you an email, and you know, we do need a response back. We need an explanation. Again, we're not telling you how to complete your call report. We just need to know why they don't match up. So.
Okay. The rest of the time we're going to spend talking about on-site collateral verifications. the selection criteria. Why are you coming out to see me? What?
Right.
Why are you
How
here?
did I get to be that lucky one?
Exactly. We do take a risk-based approach. We take into consideration your outstanding credit obligations. We also look at the financial performance of your institution. Do you have any special collateral arrangements? Have you been approved to do something unique or special? How much collateral coverage do you have? Do you run tight on collateral? Do you have an abundance of collateral? Have you changed the way in which you report collateral to us? Were you previously on delivery and now you've been moved back to QCD reporting? And how did you do on your last CV, right? How well did that go? All of these things factor into our decision to come up with our selection for a year. So we'll get into the details a little bit of how we come up with those measures. And the purpose of an on-site collateral verification is that we need to validate that the asset exists. You're reporting to us, you got 150 loans that total $20 million. Can we actually look at those 150 loans, or at least a sample of them, right? So we're just, again, trust but verify. We're just validating that they exist. We're validating that you put them and classified them in the right asset category, right? You said it's a single family loan. Do we agree with that assessment? And then we're also validating the accuracy of the data that you've provided to us. If you said that the loan matures in March of 2026, is that true based on the documentation that we can find? And so, again, we're looking for data integrity, and then we're looking to just validate the eligibility of the asset. We're doing a loan file review. We're not saying if the loan is a good loan or a bad loan or performing or non-performing or it should be substandard. That is for your safety and soundness examiners. It is strictly a review to determine if it meets our underwriting guidelines for the asset that you've pledged it in, the asset class you've pledged it in. And so the frequency of the reviews, I failed to update this slide. We have a new selection criteria that is biannual. So we have an annual review, we have a biannual, and a triannual. And so I will update this slide and we will send them out to you again. But the annual, we have our criteria below. We have our top 20. I'm sure very similar to the way that you do your credit reviews. You look at your borrowers, your highest borrowers, right, and you're going to focus in on them. And so we pull our top 20 members who are borrowing from us, and they will receive an annual review. We also have an annual review for our members who have an average credit obligation divided by their total unsubordinated assets greater than or equal to 15%. So if you're borrowing more than 15% to your unsubordinated assets, and that's on average, so it's not just one snapshot, but over a year period, and you're over 15%, you're going to get an annual review. If you are borrowing more than 5% on average to your unsubordinated assets and you're considered a significant member really means that we've identified something in your financial profile that it's not a red flag, maybe a little baby pink flag, right? Something that caught our attention, whether that's, non-performing assets or capital or something like that, that has caught our attention and required further review. So if you're borrowing more than 5% and you're considered a significant member, then that would trigger an annual review. I'm going to insert here a biannual review, and again, I will send out the slides again. But the biannual review would be if your average credit obligations to total unsubordinated assets is greater than 10%, and you have not had a review in the last 12 months. So 15% for annual, 10% for biannual, and then we fall into our triannual that shows if your average credit obligations to unsubordinated assets is greater than or equal to 5%, and you have not had a review in the previous 2 years. Then you would get a review every 3rd year. We also have the ability to manually add a member. So our selection is typically done the first business day of November. We notify you by email. We've switched to email. Before we used to send a letter, but we have submitted an email that goes to the president contact. And then we also send another email to the QCD contact that we have on file, so that we both are receiving it.
Right.
And then it's kind of a hurry up and wait sort of thing. There's a lot of stuff and a lot of back-end stuff that we're doing on our side once we make that selection. But on your side, it's really just waiting until someone reaches out. Essentially, that notification is telling you, hey, for this upcoming year,
sometime between January and December.
Right, we're going to come out and see you. And so that initial contact is what we do on our side is we take our full list of reviews that we are set to perform that year, and we have a planning meeting really with our reviewers, and we split them out, we pair them up, and the collateral review officers all kind of have their marching orders when we leave that day, and they have, hey, I'm going to go visit these however many banks. And they are going to, that's going to be my schedule for the year. And so then they make contact with you. They're going to call you. They're going to call the QCD contact or whoever the contact was the last time they were there. And they're going to say, hey, I plan to be in your area on June 15th. I'd like to do your collateral verification at that time. Does that work for you? And that's that second bullet of determine an amicable date for an on-site visit. You can say no. You can say, you know what, my daughter's getting married that week. That does not work for me. Or you can say, hey, we have another exam at that time. That's not going to work for me. We're okay with that. You can say no, and we'll kick it down the road, and we'll move on to the next one. What you can't do is say no the whole year.
Oh, right.
And then we end up in December, and, nobody's had their review yet.
So, Kylie, how much advance notice do the officers try to give the institution?
Yeah, that's a really good question.
Am I calling and say, hey, I'm going to be there in 4 weeks, or is it 6 weeks?
It's usually 6 to 8 weeks is where they're at. Some of them like to go even a little longer than that because they like to plan out their schedules a little bit. So I'd say typically 6 to 8 weeks is on average when you'll get that kind of heads up. And some of that is just the lead-in time, the prep work that has to happen. But some of that is just making sure that we've given you enough time to set notice and kind of get your things going too. And then also during that initial contact call, we want to set up who are we going to deal with the whole time, right? Like who's going to be our main contact? Who should we reach out to? If we have questions, if we need the loan list, those types of things. And then once all of that is agreed upon and the date is agreed upon and the main contact, then we will solidify that agreement and provide you with an engagement letter. And that will just sort of set the expectations for the review. In that letter, we're going to request documentation from you. We're going to ask you for the QCD loan support template. We're going to walk through let's just talk about the QCD loan support template. Essentially what we're going to say is, hey, in order for us to get started, the very first thing we need is to establish what QCD are we going to use, right? Mm-hmm. So right now, today is 3/31. If I were calling someone today, I would say, do you want to use your 12/31 QCD? Because it's done. Mm-hmm. Or would you, because we're in this little sweet spot of when your QCD is going to be due, right, before I come out, do you want to use your 3/31? I would give you that option. You can tell me which one you want to use, and then that's what we're going to work around. The expectation then is once we've settled on the QCD date, that you provide me with a list of loans via the QCD loan support template that matches back to that QCD form. Mm-hmm. So if you put on the QCD, I have 250 loans, single-family loans that total, $100 million, I would expect to receive a loan list that showed 250 loans on it with loan data detail for each of those loans. Right. That would total the amount that you reported in aggregate on the QCD form. So those two things need to reconcile. That is how we start everything. In addition, we ask for some information from you. So on the CV questionnaire, We're asking for, your credit review policies and just reporting in general. We ask for your loan delinquency report, your watch list, director, officer, employee list, participation loans. Those all tie directly to eligibility. And we can't find those in the file, usually. And so those are just reports that we ask for so that we can validate them back against our eligibility criteria.
Right.
If you have subordination loans or loans that are subordinated, we'll ask for a list. And we also want to see your loan policy, the quality control or credit review policy, and the member's internal procedures for completing the QCD form. So obviously, we hope that you have something that identifies what your procedures are to complete the QCD, but sometimes that is not available. Maybe you could prepare something real quick, or we will at least talk to you about how you do it
What
when
the
we
process
get there.
is, right.
Yeah.
Looks
And
like we had a question come in, Kylie.
Okay. Who is the most appropriate person to fill out the questionnaire? So for a collateral verification, the CV questionnaire is typically completed by the main contact that we have. For delivered loans, the certification that we have is completed by someone who's authorized. So you have to be on the credit authorization or credit resolution.
Okay. Great. Moving forward.
Okay, so once we receive that QCD loan support template that identifies for us, and it matches back, right? And it does need to match back to the dollar, to what you've reported on your QCD form. So the number count and the dollar amounts all track. Once that happens, then we're going to pull a loan sample. And the size of the sample is going to depend on how many loans you pledge to us. If you pledge to us more than 500 loans, we're going to use a statistical sampling method of 90% confidence, 5% precision, and 5% error. If you've reported to us less than 500 loans, we're going to use 10% of the loans pledged. Meaning if you reported to us 350 loans, we're going to look at 35. Okay? That's our core sample.
That's the core sample.
Right? And it is based on the distribution of the asset categories that you've utilized. So if you've pledged to us single-family loans, 100 million, commercial real estate loans, 200 million, and second mortgage loans, 50 million. In proportion, we're going to look at, just based on those numbers, we're going to look at more commercial real estate than we are single family. And we're going to look at more single family than we are seconds, because based on the figures you've provided, we want to ensure that we're looking at where you're getting your funding from, right? So we kind of distribute it based on where where your lending value is coming from.
And if you're on delivery, if you're actually delivering loans to us, we look at 100% of all those loans.
Yes.
And we look at all of that loan documentation. There isn't an exception rate. It's either going to qualify or not.
Yes.
Okay.
So the sample is 100%.
Yes.
So the core sample we talked about, if you're under 500, there is a minimum of 20 that we would look at, 20 loans. So if you reported 150 loans to us, although the 10% would be 15, we're still going to look at 20 loans in our core sample. And then the maximum would be 102 loans. Okay? Additionally, we do a targeted sample. That targeted sample, after we've selected the core sample, would be the next largest 5 loans that you've pledged to us. Sometimes that is the 5 largest, but sometimes a large loan sneaks into the core sample.
Right.
So it would be the next 5 largest loans. And then once we select our sample, we provide you that list of loans prior to arriving on site.
What?
And we do that. We do that, one, to prepare you, right? It's effort that we're asking you to do. We acknowledge that. We understand it's not, the easiest thing. And so we want to give you the most time available to pull those files, have them ready, check them out.
Make sure that all
they're good to go.
I's are dotted, T's are crossed.
Right. And so, I put myself in your shoes, and I've been in your shoes, that if someone sent me a list of, hey, I'm gonna look at these 20 loans,
Oh,
I'm gonna pull those 20 loans and make sure I've got my title policies and my appraisals and I got my recorded mortgage done. You know, I'm gonna make sure that everything is ready to go in those files before they get here.
which really leads us into this next, this is what we're gonna look at.
Exactly.
Yes, to make sure all of that's in the file, makes the review go faster,
Absolutely.
makes it go smoother. We'll get in and out of your office
Yep.
in a very timely manner.
Absolutely. So when we get there, so you provided us the sample, we've provided you the sample, you know exactly what we're looking at. Then we're gonna just come on the date that was agreed upon, right? There's some communication in there. It's not like we just
Absolutely.
show up on your door and didn't remind you or whatever, right? But, so we're gonna come out and we're gonna say, hey, by the way, remember I'm looking at these 40 loans.
Right.
And hopefully you're like, oh yeah, I knew that. Here's your 40 loans. I've already gone through them and I'm ready for you. We can have an initial meeting. Some members like to have a formal sit down before we get started, right? Some members are like, hey, I want to go over what you're going to look at. I want to go over some information, or I have some questions for you, right? Those types of things. Other members, to be very honest, are like, here's the desk, here's the computer, here's your login, there's the bathroom, I'll see you later, right?
Right.
So it's really up to you how formal you want to make that or how informal you want to make it.
Right.
It's really up to you. We don't have any requirements there. We just ask that you have someone available for us so that if we have questions, when we have questions, we know who we're going to go see and where they are, so that way we can continue to get through the review and out of your hair as quickly as possible.
Right.
Okay? And so for each loan that we've sampled, and we've collected and talked about the data back and forth, we're going to review each of them for eligibility. So we're looking at specifically some key documents. We're looking at the note, the mortgage or deed of trust. We're going to look for the title policy. We're going to look for the appraisal or valuation of that asset, and then some type of credit review usually is involved. Right, on single family, what's the debt to income, what's the FICO score, on commercial real estate, what's the debt service coverage, you know, why did you create this asset, those types of things. And then we're going to review the additional requested materials. So we had talked about those requests earlier. Hopefully you have them ready for us. You might have sent them to us ahead of time, but if not, our expectation is that when we arrive on site, that they are ready. So that's your loan policy, those substandard director officer employee reports, you know, those types of things. Anything else that we've requested of you, we would like to have those when we arrive. So, does the loan meet our eligibility criteria? So we're going to just go through super high level, right? Because not every loan is created the same and not every asset is equal, but in super high level terms, we're looking for the original note. The original note with a wet signature will need to be there. If that note has been modified, we're looking for the modification. If you attended our session yesterday, we talked a lot about the eligibility of modifications and how we've just recently changed.
As of today.
As
a matter of fact, all of our lending values and updates to our guidelines go into effect today. So, tell us, can you go briefly over the modification?
Yes.
It's exciting.
Very, very briefly. The modifications, change in terms, today, and I don't know if we included it at the end, but I'll go over it briefly anyway. Before they had to be original wet signature, and effective today, we are allowing modifications, change in terms, renewals with an electronic signature or a copy of document or a copy of the previous wet signature.
So like a scan copy?
Yes,
That
like
works,
an image.
okay.
Yeah. Where before it had to be original, we are now going to allow a copy. And I've got a slide later that will go over some key details, some nuances to that. But it is a change. So we're going to first look at that original note that sort of sets the tone. What are the terms of the note, of the agreement that you have with your customer, and then walk through the collateral piece from there. So then we're going to look at the security of the note. How did you secure it? Do you have a mortgage or deed of trust? Is it an equipment loan? Is it ag operating? Do you have a security agreement? You know, those types of things. So it's going to depend on if it's real estate or non-real estate, what it is exactly that we're looking for. Additionally, we want to establish what is the lien position. The way that we do that is looking at the title policy. That will tell us if there are any liens that supersede your lien. Additionally, if it's non-real estate, we'd be looking for that UCC search. And then finally, the loan to value, which is a criteria in every asset category that we have. What is the current loan to value? Right. And we get there through an appraisal or evaluation. Talked a little bit about the credit review. We're looking for the FICO or debt to income. We're also looking for on single family assets, income and employment verification. Did you validate that they said they made X number of dollars per month? Did you obtain income that it's not just stated, or, you know, that all those bad things that happened in 2008 and 2009.
Got us in so much trouble.
Right, and then we also talked about the commercial real estate, multifamily, the debt service coverage ratio requirements there. Sometimes there's supplemental information or documentation that may be needed, but sometimes we don't know that until we get in the middle of a file, right? So sometimes a phase one is needed, depending upon the type of commercial real estate property it is. We may then ask you for a phase one. Sometimes an annual financial statement may be needed if it's a residential construction loan or a ag real estate loan that's interest only. So again, some of that we don't know to ask for up front because we don't know until we get into the file to determine if there's additional or supplemental information that we need. Additionally, on the PACE validation, if we identify, hey, oh, this is a PACE loan, then we're going to ask you for that tax statement to prove to us that it does not have a PACE lien. And then there's some technical exceptions, right? The security instrument, was it filed properly? Was it notarized properly? Does it have the correct dollar amount for coverage, right? So if you lent to Elaine $100,000, did you issue the security instrument or the mortgage for $100,000, or is it only $75,000, right? So there's some technical things that we're looking for. Definitely the data comes into play in a lot of that. I gave an example earlier where if you told us in the data that the maturity date is March of 2026, but what we find in file is a matured note as of March of 2023, then we're going to ask you, hey, your data doesn't line up. What's going on there? Is there a modification I'm missing? Was this a typo? You know, that kind of stuff. And then definitely if we find, you know, that the rate that you provided to us is different than what's being shown on the note, we're going to ask some questions about that, right? Is it a typo? Sometimes it is.
Sometimes it's
That's okay.
Sometimes it's a modification.
Sometimes it's not a typo. Sometimes it's like, oh man, we failed to put that into our system correctly, and we're charging this member the wrong rate or this customer the wrong rate, right?
I'm assuming you've run into that before.
We have.
All right.
Additional qualifications to show our eligibility. The past due, right? Is a loan past due? We have 90 days and 65 days? If you have questions about specific eligibility, I'd encourage you to attend our eligibility webinar next week. But we're definitely looking at those reports that you've given us. We're going to check those and tie them back directly to our eligibility guidelines. And then finally, the servicer custodian information. If you have a third-party servicer or custodian, we want to make sure we have the right information on file. And then we're looking for consistency throughout the file. And some of this is just kind of fraud detection, if I'm being honest, right? Do the signatures line up? Do they make sense? Is the same person signing the same document in the same way? We're tasked with that. And so it is a check that we do.
Regulatory.
Yes, super fun.
Yes.
So then what is the process? Once they're on site and they start looking through the files, what's going on? Hopefully all your files are clean and they're just keeping you informed of like, hey, I'm on file number 10 out of 20 and I should have this much time left, right? Like I'm projecting I'll be out of here in the next couple days or whatever that is. But the collateral review officer will be in contact with you, whoever it is that you've assigned for them to be in contact with throughout the review. If that's more than one person, they'll probably ask like, hey, is that an email? Do you want me to keep you informed via email? Do you want me to keep you informed? Like, do you want me to stop by your office every night when I'm leaving? You know, that kind of thing. So again, just establishing that good rapport is important. So they're going to work with management or assigned staff while they're on site. They're going to provide that daily update for progress and exceptions found. Typically, if they find an exception as they're going through, they're going to say, hey, I can't find the title policy in this file. Can you help me look for it? I've combed through it. I can't find it. I've always said this. You know your files way better than we do. I have been to so many reviews where I'm like, I cannot find this document. Right. And I take it in and the person's like, oh yeah, that's so-and-so's file. And they flip right to it, right? Because they just know. Mm-hmm. And that's okay. I don't get offended by that. I would rather you get to it much faster than me sit there and spend for hours wasting my time and yours.
Or it's, oh, well, we keep that over here in a different file.
Right.
So we want you to be successful. This is not a, oh, we gotcha type of process. We want you to be successful. We want to make this process as easily as possible for you. Mm-hmm. So we want to work with you. Mm-hmm. I'm missing this document. Can you help me? Can you go find this? Mm-hmm. So absolutely. And so what we do throughout that progress and provide you with an update on those exceptions is we tell you where you're at in relation to the exception threshold. So exception percentage is based on the number of exceptions that we've identified divided by the total number of loans in the core sample, okay? So depending on what size of your core sample, that will tell you how many exceptions that you can have. Additionally, we must maintain our 90% confidence level. And then we're going to share the final results with you at the end, right? Additionally, part of us being on site is you've got FaceTime with a collateral review expert, right. Honestly. Everyone who's been on the collateral review team has been here at least 5 years at this point. They know what they're talking about. And so some of them have been here, anywhere from 10 to 15 years, most of the team. Mm-hmm. And so if you have questions about collateral, or if there's a loan that you haven't pledged in the past and you're like, not really sure whether them. Right. Yeah. You pick their brain. Right. Use them. Right. We want you to. We did have a question come in on the chat. Where do you get your list of PACE areas? So when PACE first came out, Amanda, there was a lot of like, how are we going to keep up with this? So the Federal Home Loan Banks as a system hire or have hired a vendor who tracks that for us. And they track where all across nationwide, where there are PACE programs, and we get that list monthly. So if things are updating, we get that list monthly. It provides us with a list of zip codes. We enter that into our software that we use for reviews. When we enter in the zip code for the property as part of our review, it will alert us of whether or not it is in PACE or not. I hope that answers for you. Okay, so then once they perform their review, they're going to return to the bank. They're going to compile and finalize the results. Once they do that, they're going to provide a report to management for review and approval. That's typically me. If it exceeds our exception threshold, that has to go to our chief credit officer. But if it's below the threshold, that comes through me, and then we just finalize it and send out the letter. So once we have approved the final version, a letter will be sent to you, and then we will assess the fee, the collateral verification fee, at the end of that month. If there is one. If there is one, which we are going to go over. Just, yeah. Is it next? Okay, hold on. Well, we're going to get to the collateral changes and talk about that. Oh, just a little tidbit of more great information. So what are the possible collateral actions? First is there's no action, right? You had a great review. There's nothing that came about from it. And thank you so much. We appreciate your time. Here are your results. See you next time, right? Those are my favorite letters to send out. Sometimes there's a written response required. Maybe you had an isolated issue in one asset category or something that was recurring, or you got close
to the exception threshold, right? So sometimes there's like a, can you tell us how you're gonna improve this and prevent it from happening again, kind of thing. Sometimes an amended QCD form is required, depending on the amount compared to your overall collateral, depending on the type of exception. For example, if we find non-traditional subprime predatory loans, we are absolutely going to ask you to amend those. It is a regulatory requirement and a hot button issue for our regulators, and so that requires a full-blown amendment of your QCD form to not only remove those assets we found, but any that are like them, right? More on the harder side of things is if we exceed that exception threshold and we have to discount your collateral, then what we would do is in that event, if you exceeded the threshold, then the percentage that we identified, we would discount your collateral, that full percentage.
Your whole collateral base.
Right.
Loan collateral.
Yes.
It does not go across any securities or cash.
Right. But your loan collateral would be discounted. And then the collateral would remain discounted until we could perform a successful follow-up review. And that essentially looks exactly like the original review. It's just with new loans, a different QCD form, and we're hopeful that the results are better.
Right.
Right? Listing requirement. In the very extreme scenario where we've gone back maybe a few times and there's not improvement on the collateral verification, sometimes we move to what's called a listing of your collateral, which means you have to submit to us a loan list, and those loans have to be approved prior to reporting on your QCD form. And the most extreme, I would say, is the delivery of collateral, which would mean in order for you to receive value from us, you would physically have to deliver in those promissory notes and supporting documentation.
And we would go through every loan when it came in.
Yes, every loan would be reviewed. Okay. Other actions, sometimes, again, if it's isolated to one example I can give you is you have all of your collaterals good except for we found an exception on every single one of your HELOC loans. We may just remove your lending value from your HELOC loans and let the rest of your collateral stand. And try to just address the issue,
right,
as opposed to putting
across
some
all asset categories.
Exactly.
Okay. All right.
So let's talk about the changes for on-site collateral verifications. We talked a little bit about the biannual add, which I will add into this slide as well. But bigger changes for you guys to know about is the way in which we calculate our exception rate, which is why I've not talked about it until we got to this slide. So before we had just a straight 10% threshold. We continue to have that 10% threshold. So if your count of core loans is 30, you can have up to 3 exceptions to stay at that 10% or less, right? If you exceed that, we're going to then start to look at our loan amount exception rate and the average exception rate. So what we found is that by using just a count, sometimes the count did not fully grasp the magnitude of the exceptions that we were finding because those amounts were higher. Does that make sense? So what we will now do, the application of the new exception rate is if your loan count goes over 10%, right, which was our standard before. So if we take your number and it goes over 10, we will then look at the amount, and if collateral is discounted, we would use the average of the 2 figures. Okay? So if I go out and I look at Elaine's bank and her exception rate for count is 15%, right? Okay, I should have used an even number so my math is easier in my head. It's 15, we're going to make this easy. It's 15% is her loan count exception rate. So over my 10% threshold, right? Instead of just discounting her 15% as I would have previously, I am now going to look at her loan amount, okay?
Of the exceptions.
Of the exceptions, Correct.
So of those 15.
Of those same 15% loans, what is the amount of those loans and what is the impact? If her loan amount exception rate is 25 and it's higher, I'm going to use the average exception rate, which in this case, because I did the math right, is 20, right? So the amount that would be discounted would be 20 instead of before the 15. If the amount were less, if it were 8%, the minimum average would be 10. We would always stop at 10. Okay. So even if she was at 15 and her loan amount was at 2, I would cap at 10. And 10% is what we would use for the discount. I hope that makes sense. I know that that's a lot to throw at you, but there is a new exception rate calculation that we will be using, and it will factor in the dollar amount of those exceptions that we've identified. Okay? Looks like we had a question come in. In the past, a large loan sample wasn't included in the exception threshold. Is this still the case? That is very much still the case. This is just the core. The large loans is a targeted review, and there is not an exception rate for the large loan review. So that's a great question. Thank you. And I'm sorry I didn't clarify that. Okay.
All right.
Okay. Then the other one, which I think is a good thing.
Oh, absolutely.
Is we are going to, for our fees, we have adopted for this year and hopefully moving forward, the first 20 hours are at no fee. So the first 20 hours of our review time is free. After the first 20 hours, it would be $125 an hour. And that would not then start back over, like, oh, if you went over 20, it starts back at the first hour. No, it would just be starting on the 21st hour, right?
Right.
So your first 20 hours are free. Anything 21 hours and above would be $125 an hour.
So, true incentive to have your loan docs pulled, and you've gone through them, made sure that all of the documentation that we require is there, and it's an eligible loan. You could essentially walk away, we would leave, and there would be no fee charged to you. Mm-hmm. So we feel like this is a great win for our members.
Mm-hmm. Absolutely. Okay.
Minimum eliminated, what's that?
Well, before we had a minimum of $500.
Gone.
And so it's gone. I couldn't tell you the last time we charged the minimum. It's been a few years, but yes. Other collateral changes that we've had, we increased the maximum lending value for individual loans, and this would just be for loans that are on delivery.
On delivery that we actually hold in our vault.
Yes. So we have increased the individual loan limit for multifamily and commercial real estate. Previously, it was $75 million. They have been increased to $200 million. And then we alluded to this a little bit earlier.
We did. We're going to talk about those loan modifications.
Yes. We have requirements for loan modifications have changed. So modifications, extensions, renewals may have electronic signatures, provided it complies with our requirements for electronic loan modifications or copies of loan modifications. I would encourage you to go out and pull the scheduled eligible collateral. This is written in much more granular detail. These are just the highlights. But first and foremost, you must retain the original wet ink paper note. If the note is not original wet signature, it's out, right? It doesn't qualify. If you have and maintain the original wet ink paper note and you decided to change the exception, or excuse me, not the exception rate, the note rate, the maturity date, you extended it, whatever you did to modify that loan, if you completed that through electronic means, meaning they signed some type of digital device, a tablet, they typed in their name, DocuSign, those types of things, or they signed it and then you scanned it into your imaging system and got rid of it, we will now accept that on a modification. Not a promissory note, but a modification, yes. Okay? It must be an amendment to the paper note and not a restatement that replaces the paper note, right? So this is not a refinance loan that stands on its own, right? If you've created all new terms, all new documents, all new loan number, all new everything, that's not a modification.
No.
That is its brand new note that stands alone, right? But if you just modified and the original promissory note stands, the modification can have electronic signature or a copy of a previously wet signed signature. Okay? If the mortgage had to be amended, then it would also be required. And we ask that you maintain it in a format that's accessible. Again, if you have an imaging system, however you did that, it just can't be in some sort of like weird cryptic code that we don't have access to, right?
Right. So when we're out on site,
right, we
we'll
ask
need to
you
look at
for
it.
it and you give it to us, yeah, definitely. Specific to electronic loan modifications, right? They must comply with eSign and UITA. Most of them do. Most of the software that's out there these days, especially in the last couple of years, complies, but it is up to you to make sure that it does. Typically, it's written right into the document that it complies with eSign and UITA, but you just want to make sure. If you needed to modify the mortgage or deed of trust, and you did that with an e-notarization or a remote online notarization or a RON, we will accept that if the state has allowed it and if the county recording office has accepted it. And you would be responsible for knowing that. It would be far too vast in the 50 states for us to know who's doing e-notarization and RON and those types of things. So we're asking that responsibility fall to our members. This one's a big one for me because I can see it being a thing for some of our members. But the electronic signature must occur on or prior to the effective date of the change in the loan modification. So if you have a modification and it's not signed and we come out and we see it, and we're like, hey, this modification's not signed, you can't then go get an electronic signature, right? You cannot backdate an electronic signature. It needs to be there, it needs to be present at the time of signing, okay? And then the borrower must provide affirmative consent to conduct the loan transaction electronically. I know, oddly enough, you have to give permission for someone to use your signature electronically. Typically, that's kind of embedded in some of the stuff, right? Like when we sign things,
right,
it's embedded in there, but you just want to make sure that that affirmative consent is accessible and that we can see it, and because it's going to be something that we're checking for. And we would not accept modifications that are executed by biometric means, meaning, an eye scan or a breath something,
fingerprint.
Or fingerprint. We would not accept those.
Or even audio video.
Right.
Recording of it.
Right. Even if you recorded and said, I accept the terms of this note, it would need to have some type of signature. It is effective, as Elaine said, starting today. And so with your 331 QCD submission, if you have been kicking out any of those loans that have copies or electronic signature for modifications only, please add them back in. And modifications executed before today will be grandfathered in.
Excellent.
And we would accept them. And I think we had a question come through.
Awesome. So if we get a modification and it is dated after the effective date of the document and we did not pledge it, but later the customer came in and we had them wet signature the document, can we pledge it then?
Yes. This is going to sound crazy, but it's the truth. I can't track when a document was wet signed, right?
Right.
I can't. I can when it's electronic signed. And so that's part of the whole point of electronic signatures, right, is that you can track the date, the time, the location of when those signatures happen. And so because of that, it's sort of, double-edged sword a little bit.
Right.
Because you have more access to it and more information, you then have more requirements with it. But with a wet signature, there's no way I would know when it was signed, right? So yeah, if before they had had an electronic signature, but you went and got a wet signature, that'll work.
That was a really good question, Kyle.
Yeah, thank you.
All right. So, what are some of the problems you run into, Kylie, out on the
So
road?
frequent problems are simply missing documentation, right? You don't have the final title policy, or there's no appraisal, or, right? There's just something missing in file. Phase one, we see sometimes when environmental reports are not provided or available when they're required. And that's with any property that would have an environmental impact, right? So examples, Jiffy Lubes, oil changes, anything you have to dispose of something properly, or you're worried about the impact it would have to the environment, it needs to have a phase one.
Yep. Needs to have a clean
phase one, correct.
There are some requirements there.
Yes. And then every now and again, we'll find loans with subprime, predatory, and non-traditional lending characteristics. Some of that is just, it's older. Maybe they didn't retain or keep the tax return,
Mm-hmm.
right? They've gotten rid of it. Subprime, definitely the FICO score requirements, the debt to income requirements, you want to check those and make sure. Sometimes we find that there's just not title evidence or final policy in the file, which is, everyone is allowed to write their loans the way they choose.
Absolutely.
Right?
Absolutely.
I'm not telling you, again, I'm not saying it's a good or bad loan, that it will pay or it won't. That is not my role. That is not my job. But what I can tell you is if it's eligible or not, right?
To pledge
to us. Not fully secured by eligible collateral. So sometimes there's a loan and they took a commercial real estate building, and then that didn't have enough to cover, and so they took the vehicle, right, of the borrower. Well, we can't take vehicle loans. Or they took a personal guarantee or something like that. So for you, it is perfectly secure and good and all of that. For us, it has to be secured by eligible collateral. The UPB exceeding the mortgage or deed of trust amount, that happens every now and again. We'll see that pop up where it either just didn't get modified or it didn't get identified correctly to begin with.
Right. Happens.
Revolving lines of credit or loans not fully advanced, we do see that quite often with like maybe commercial real estate where it's more of their like operating account or business account, and so it just didn't get flagged correctly, right?
Makes sense.
And then the interest-only term limitations, definitely keep an eye on what our limits are for interest-only and make sure that, the term is not the term left over, it's the term from the start. So even if the term,
maturity.
exactly. So even if the term only has 5 years left, if it started and it was a 10-year IO period on commercial real estate, well, our limit is 7, right?
Right.
And then matured loans, which is really weird.
Right.
You would think that matured loans, we wouldn't find them, but we do. And sometimes the thought process behind that is more it's not past due, right? Because we have past due limits. But a matured loan that has no expectation of repayment because it's matured and it's called now versus a loan that's past due are different.
Two different things, right?
Yeah.
Matured loan,
Yeah.
it's just gone. It's just done.
Yeah. So the biggest topic of discussion, and I'm sorry we're running right up on our hour. I didn't think that we would, but our biggest topic of discussion that we have constantly is wet signature. E-notes, we do accept e-notes at this time, but what is an e-note is that it's a note that's executed electronically, stored in an e-vault that meets the requirements for an e-note. If you want to talk more about e-notes, or if you have questions about e-notes or how you can get started down that path, certainly reach out, and I'm more than happy to share my knowledge with you. I cannot pretend to be an expert, but I am happy to share with you what I know.
We have taken our first e-note at Collateral.
We have.
That was pretty exciting. That was big.
Yeah.
We've been working on that for years.
Yes. So what an e-note is not is a scanned image of a wedding signature, right? Or a note with an electronic signature that's not stored in an e-vault and does not meet our e-note requirements. So if you're using electronic signature on your promissory notes, those are not eligible.
You can always find all of the most updated information at that website that we have listed there.
Oh, yeah, our landing page, our
yeah.
e-notes landing page.
Our
Very good.
members-only portal. All right, so we did hit the Q&A here. I know we've answered questions along the way, so
If you have any others.
if you have, yes, please. But just overall, accurate reporting of eligible collateral is so important. It establishes your borrowing capacity at the Federal Home Loan Bank. It allows you to maximize liquidity by allowing non-liquid assets to be used as collateral. It reduces expenses associated with the collateral verification, so eligible loans are a lot faster and easier to review than ineligible, because we're going to try to help you make that, if there's a possible way to get that documentation or make it so it can be eligible, we're going to help you there. We're going to spend time. We do have some upcoming educational opportunities. The annual management conference is just right around the corner. It's an awesome conference. We've gotten lots and lots of great feedback over the years, very educational. We also have regional meetings that will come up this fall in each of our four-state area. There will be more information coming out to you as these dates get closer. And as always, collateral review contact, one-on-one guidance. Utilize the resources. They're here for you. We want you to be successful. That's our job. That's our goal. We want you, our members, to be successful. Here's Kylie and I's contact information along with our group email addresses for our staff. Please, 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 if you have any questions, reach out. We're here.
Yeah, we'd love to hear from you. That's what we're here for.
Absolutely. And we do greatly appreciate you all taking time out of your busy schedules this afternoon to join us on our webinar. We are going to repeat this collateral webinar series next week at 10 o'clock on Tuesday, Wednesday, Thursday. And on Friday, we are just having a straight Q&A session. So if you come away and have more questions that you really want to just vet, please feel free to join us next Friday morning at 10.
Yeah.
We're excited.
Yeah, it's a really good opportunity, I think, to ask some of those more unique questions that you have, like, hey, I have this loan. And that way it kind of prompts everybody else to also ask questions. We just have one question come in that says, 1 to 4 family real estate notes with FICO less than 620 cannot be pledged, correct? That is a loan below 620 with a FICO less than 620 would need to have a compensating factor, right? So we would ask, like, hey, what is the reason that you went ahead and used or created this loan? One of that could be, it has a debt to income of 16%, right? They're more than they're more than able to pay for it. Maybe they've had some credit problems in the past, but they're in a good space now. The loan to value would be a compensating factor, years on the job, stability of income. Again, all of those credit factors that you look at when you're looking at a full picture of a borrower.
You need to document that.
Yes.
You need to document why you thought it was okay to continue on after that 620 FICO.
Yes.
Oh, yeah.
Yeah. I'll tell you what it's not. It's not like, well, I changed his brother's diapers, and so
I've known that family for 30
I've known
years.
them for years. They always pay us, right? Ones that get a little tricky.
So, and the presentation, somebody asked if we would be sending back out the slides. I think we're going to make an amendment to the slides.
Yep.
And so, yes, we'll send those back out or make them available for your review.
Yep.
These webinars also will be posted out on our members-only collateral landing page that you're free to review at any point in time.
Yeah, so if you have somebody new on staff or if you just want a refresher, they're always out there on our website. You
Right.
can just listen again to our lovely voices.
Right. Or, like Kelly said, if you've got new staff,
Right.
you think that they could benefit from that, just point them in that direction.
Yep.
So, all right, well, it's 5 after. We will keep you no longer. We appreciate your time, and hopefully we'll talk to you all soon.
Thank you so much.